What's up, guys? It's Cashflow Cart. Today is the 4th of July for me. Notice the hat. Also, notice I'm not even at my desk because it is a holiday and I am definitely being a little more lazy today. With that being said, I did want to film. I have another update on the Hershey trade. Um, if you guys have been keeping up with kind of this mini series about me starting the Hershey position, you will know I trimmed Apple at 215. Apple made an all-time high actually yesterday on the 3rd of 221.55. If you guys saw the Nasdaq yesterday, it was pretty much straight up all day. So Apple did close at an all-time high. Um, I'm still happy with my trim on Apple at the 215 fill, and I obviously did reallocate these funds into the Hershey position. I was able to afford 15 shares from that trade. I had put on 2 with dividends and cash, and then I added 15 more from the Apple trade. And as you can see, there is another 12 share purchase here on Hershey. And for the funds for these 12 shares, I actually did a pretty similar move with my Microsoft shares. I was at 20 shares of Microsoft. I've taken that down to just 15. And today we're going to talk about the reasoning for that, as well as, what that did to my dividend income. Let's get into it, guys. I'm excited. First, we are going to start off just looking over the portfolio from a broad perspective. I know I just dropped the portfolio update, and usually the once a month update is, a pretty good schedule. Not a lot changes in my portfolio from month to month, besides, obviously reinvested dividends, picking up more shares if I have cash to deploy. But, starting this new position in Hershey, I will say the end of June and the beginning of July have been there's been a lot of changes in the portfolio. So we will go ahead and sort by market value. Again, Altria being the biggest position, then Realty Income, then Apple and Microsoft. And guys, I do want to bring up a point here, okay? So let's look at this. What percentage, we'll get the exact percentage right now, of the SP 500 is tech. Okay? Let's go ahead and look. Today, financials and information tech comprise 42% of the S&P 500, with tech representing 29 percentage points of that figure. Okay, very interesting. The S&P 500 right now today is made up of 29% tech. I wanted to bring up, okay, how does my exposure to the tech sector compare to the S&P 500? So obviously, looking over my 8 positions, we can see, my 2 plays that give me tech exposure are Apple and Microsoft, guys. So all we're going to do is take, the $11,077.50 from Apple. We're going to add that to Microsoft, $6,911.55. And then we're going to go ahead and divide that by, the figure of the overall portfolio value. Right now, that is sitting at $58,958.89, guys. That takes me at 30.5% of my overall holdings in this portfolio are in tech. Pretty in line with the tech exposure to the S&P 500. Before I made these plays, I was a little bit overweight in tech in comparison to the S&P. After these 2 recent trims and reallocation to Hershey, now I'm more in line with it. And I don't bring that up to say, you should try to mimic the S&P 500's diversification. I bring that up more to say I did feel like I was getting a little overweight in tech, as we've seen you know, vast outperformance of the tech sector compared to the S&P, guys. So, with all the share price appreciation we've seen in Apple and Microsoft, I was getting a little bit uncomfortable with my tech exposure, and I do realize, any sort of correction in the Nasdaq and tech sector specifically could hit my total portfolio value pretty hard. I do think I picked an opportunistic time to kind of rotate out of these. We will go back to the Microsoft chart to look at this. So, as you can see, 2023, the beginning of 2023 in Microsoft, as well as now we're halfway through 2024, guys, that's 18 months that Microsoft's been on, an absolute tear. Okay? And from my trading experience, I do feel that not only Microsoft, but Apple and the tech space as a whole is due for kind of a correction. Okay? We see right here, I don't know if you guys use any momentum indicators, but I typically like to use the MACD. I've done some, experimentation with the RSI. However, for my personal tolerance, the RSI is going to give, too many bad signals as compared to the MACD. It's a little slower moving. You can see over here how I have it set up, 12, 26, 9, and the exponential. So what do we see here with this bearish divergence, guys? On the MACD, we have, what we would call in technical trading a double top. Okay? Do we see here how, back in June of 2023, the MACD made a high. Fast forward a year later, the MACD matched that same high. Okay? That's what we call a double top in terms of technical analysis. The reason why we would identify this as bearish divergence is, we look at price action and the top on the chart coinciding with this top on the MACD in 2023 is lower than that of, later on in 2024. So as price continues to appreciate, we see momentum kind of slowing. Does that make sense? And that often is, I say often because obviously, we can't we can't say technical analysis is going to explain everything, but oftentimes this coincides with kind of a correction in the market or an individual security, like in this case, guys. And we do actually see, a pretty similar thing with Apple, where we saw a higher high on the MACD in 2023, and then now in 2024, although price has gone higher, we are kind of seeing that momentum slow a little bit. Okay, does that make sense? One other thing I want to mention before I stop yapping about the charts is, guys, if you've been following the channel, as a long-term investor, I typically like to use weekly candles in my charting. So here we have the max time frame weekly candle chart for Microsoft. With that being said, this green line is a 200-week moving average. I often use that as well as the 50-week moving average being the blue line. And if we look back on this chart a little bit, we do see, sometimes when Microsoft corrects, it does typically bounce off that 200 week. Does that make sense? And now, we see price the most overextended it's been from that 200 week moving average since, December 2021, guys. Okay? You can see here I kind of had a similar take, trimming my Microsoft position in December 2021, and then I added back to it after we did see price come down to this 200 week. That's kind of, I think that's kind of the most likely case here with Microsoft as well as these other tech giants is that we start to see, somewhat of a correction. And, obviously with guys with this type of market cap, it should coincide with the market slowing down a little bit. But in December of 21, we saw the Microsoft price action was 110.4% above that 200 week, and we will look at where it's sitting at right now. Right now, it is 58% above that 200 week. Both signs of overextension, and when Microsoft did finally correct, it did actually double bottom off that 200 week moving average. I was able to pick up 10 more shares, and I was able to take off 5 of these 10 shares just recently. Okay, guys. On the flip side of that, if I head over to Microsoft's chart, and I do want to mention, guys, I know a lot of times I'm talking about dividend metrics and valuation metrics. I am a dividend growth investor. However, I feel, this type of rotation in my portfolio has been brought on not only by valuation metrics, but it's also been brought on by, technical factors. So we go over to Hershey's chart. You can see just in the past, week and a half, I've started building this position. I'm currently at 29 shares. We do see anytime Hershey has kind of dipped below this 200 week moving average, it has been historically, it's been an opportunistic time to kind of enter a position in this one, guys. So, I'm hoping that we will see Hershey continue to consolidate, maybe for the rest of the year. I can build out this position, and then, we will see a reversal. Obviously, I'm looking at a 53% upside on Hershey just if it returns back to its all-time high. I would anticipate that takes through 2025 and maybe, partially through 2026, but we'll have to wait and see, guys, and hopefully I can build out, an even more meaningful position in this one before that time comes. Okay, so enough yapping about technicals. I know that's probably not your guys' primary interest. However, I do want this channel to be very transparent, and I think if I make a move or make a trade because of something I see, it doesn't make sense for me to not give the full story to the channel, guys. And that's what I'm trying to do here today. Another thing I do want to mention, guys, you probably saw in last week's video, my monthly average last week was $204. Now this move has taken my monthly average up to $209. That's an additional, $5 a month. Okay, it is what it is. But my estimated annual income, has broke that $2,500 level. Okay, so that's pretty cool. We are still chasing, that $250 monthly average. That's what I've got my sights on currently. Okay, one other thing I did want to mention, guys, and I did go through kind of this valuation process with Apple. I'm going to look at it the same way with Microsoft, and I think it should tell a pretty similar story. So my favorite way to determine undervaluation as compared to overvaluation in companies is going to be this metric right here. It's going to be price to free cash flow, guys. The reason why I use price to free cash flow as opposed to, price to earnings or any of these other metrics, as a dividend-focused investor, guys, dividends are paid out of free cash flow. So, for that reason, I really want to focus on a company's cash flow growth as well as its ability to sustain the dividend. Does that make sense? So, that lends me to wanting to use price to free cash flow on a forward basis, and that kind of helps me determine, valuation, fair valuation of a company, guys. We are on Microsoft. We can see their current forward price to free cash flow is 29.33, guys. We're not going to compare that 29 figure. We're not going to compare that here to a sector median. And the reason why I discourage you guys from using kind of a sector median when doing these comparisons is this. Okay, any company like Apple or Microsoft, it's automatically kind of going to trade at a valuation multiple premium. Okay, these are the premier guys. They have shown that they have led the market in terms of share price appreciation in the past decade, and they've kind of earned this premium. So with that in mind, it doesn't really make sense to compare Microsoft to, the sector median being its peers who don't have that kind of same respect in this space. Does that make sense? Rather, what I like to use is Microsoft's 5-year average. Okay? I've learned that kind of the best way to identifying undervaluation or overvaluation in a company is to compare the current metrics to its own metrics on a trailing basis. Okay? I use the 5-year basis. I'm comfortable with that. In the past, I have used kind of the 10-year average as well. But I will say, I think the 5-year average is the best for someone in my case who's looking to kind of lock in an attractive starting price as compared to, where it's been over the past 5 years. I think that's enough time for me to kind of, judge these companies. So we said right now Microsoft's is 29.33 currently. The 5-year average is 24.43. And the good thing here on Seeking Alpha, it will give you here the percent difference to 5-year average, guys, is 20%. So with that in mind, we can kind of deduce from this that Microsoft is currently 20% overvalued. Again, that's just using one metric, but I'm using that in conjunction with kind of my sentiment around the tech sector as well as my technical analysis of Microsoft stock on, a weekly chart. We will look at Hershey. We'll kind of do the same thing. I know I just went through this not that long ago, but, it makes sense. So we said Microsoft was 20% overvalued. We can see Hershey's price to free cash flow on a forward basis is 13.56, and their 5-year average is 24.43. That signals in Microsoft it could be as much as 45% undervalued right now, guys. Based off the charting, we said there could be about 55-56% upside to Microsoft. That would make sense here, coinciding with this 45% undervaluation we see from this metric, guys. In a broad sense, my reason for trimming Microsoft and moving those funds into Hershey, it was very, very similar to kind of my Apple reasoning. Okay, I did take kind of my I did take my tech sector exposure down, quite a bit. However, I still technically have, more exposure to tech in my portfolio than the S&P 500. I don't know how I feel about that, but I do want you guys to keep in mind, the purpose of my portfolio is not to be a swing trader, not even really to be a position trader. It's more to build, my dividend income, to increase my dividend income year after year and get it to the point where I'm just, continuously hitting milestones. And then at some point, that next milestone is going to be like, a meaningful amount of money to kind of cover a lot of my cost of living, guys. That's kind of every dividend investor's goal is to create a portfolio that can fully sustain, your cost of living, or at least, do some damage to your cost of living per se. So, yeah, again, I don't want you guys to think I'm always actively trading. However, recently, with all the bullish sentiment we have seen around, Microsoft, Apple, Nvidia, and the tech space in general, I did think it made sense to kind of trim up some of these guys. Guys, this has been kind of more of a laid back video. I said it is a holiday. I don't have work today. But I did want to film something and kind of, update you guys on this move while it was fresh on my mind. Again, this is Cashflow Cart. Thanks for all your support, guys, and let's build wealth. I'll see you Monday.